Good morning. Welcome to Trading Hour. It's a Friday morning. I'm Reema Tendulkar. With me is Vivek. And markets are selling off. We're at the low point of the day. The Nifty is at 2,400, a cut of 180 points. And the problem is that two of the largest sectors, IT and banks, are dragging their feet. IT, of course, had a big rally in the prior session. So there is a bit of profit booking because week to date, IT is still on the flatter side.
Absolutely right. Good morning, Reema. So session highs, markets have cooled off, and it's a significant cool off. And the IT pack almost 1.7% lower. For a change, what's actually doing quite well is actually the oil and gas pack. So ONGC today is the top Nifty gainer. Jeffries today said that the stock correction as far as ONGC is concerned has been overdone. And they believe it's one of their top buying opportunities as far as ONGC is concerned. The other couple of stocks that have managed to hold out in what's been a very weakish market, especially in the last hour, is actually two power financier companies, both REC as well as PFC. Emkay has initiated coverage on both of these stocks with a positive bias. They have a buy rating over there. And Reema, you've been looking at the entire auto pack. A little bit of a cool-off as far as the two-wheeler space is concerned. Both Hero as well as TVS Motors today seeing a bit of a cool-off.
So Hero Corp came out with numbers yesterday. So that's the one reacting to the auto sales numbers. And it's a weak set of numbers. In fact, autos have been under pressure. Both Bajaj and Hero Motor Corp are nearly 30% off from their recent peak levels. Now, on to Hero's numbers. Total sales are down 18%. The street was anticipating a 5% drop, so worse than expectations. Domestic sales are down 22%, while exports are up 91%. And the problem is on the export front. Look at the domestic sales numbers. For Bajaj Auto, if you remember, we kept saying total sales are down 1%. Well, total sales may be down 1%, but domestic sales were down 15%. Even for Hero Motor Corp, it's a 22% drop in the total sales. And for TVS Motors, while the total sales were up 7%, domestic sales were flat. So at least in the month of December, maybe it's on account of the fact that post-festive buying, things have cooled off or, slackened off a bit, but domestic has been under pressure. That said, export numbers are very strong across the board. So for Bajaj Auto, 18% jump in exports. Hero Motor Corp, it was a 90% increase. For TVS Motors, a 22% increase. And the other trend is premiumization. So Royal Enfield numbers looked up. So total sales were up 25% and domestic sales went up by 18.5%. So the trends that stand out is domestic weak, export strong, premiumization as can be seen in Royal Enfield's numbers, and electrification. And in electrification, that's EV sales, which are now about 6% of the total sales. Bajaj Auto is in pole position, followed by TVS Motors, and then you've got Ola Electric with a 19% market share.
Thanks so much, Reema, for taking us through the internals as far as the auto sales were concerned. Well, moving on, one stock from the broader end of the market that's doing quite well is Wockhardt. The stock surges in trade after CDSCO has approved oral pneumonia antibiotic. Winnie joins in with more details.
Yes, good morning. So we're seeing a sharp run-up coming in for Wockhardt today. Now, CDSCO, that's the Central Drug Standard Controller Organization in India, has approved this new generation antibiotic drug that is McNAF. It is also a niftyramycin that is there. This is used for treatment of a community-acquired bacterial pneumonia, and this is mainly in adults. Now, why is this important is because this drug, which is used for this treatment of pneumonia, it is actually covering the entire range of this disease, which is the community respiratory pathogens, which also includes pneumococcal, which is an important, treatment that is required for this disease. Now, this disease, actually, the other medicines which are there currently and drugs that are there, that is azithromycin and amoxicillin, that are not working well for this disease. Now, this drug covers it completely, and that is why it's a positive that comes in for Wockhardt on that front. And in terms of currently in the Indian market, CAPB affects around millions of people worldwide, and in that, 23% of that disease is impacted for people in India. So important to watch out for this one.
Thank you very much for that. And now let's get to ONGC, the top Nifty gainer of the day. Upasana is here with the key highlights from a Jeffries note on the stock. Upasana.
Well, Jeffries has given a buy rating on the stock but has cut the target price by 6%, that is at 385 per share from 410. Now, the brokerage says that the 30% correction in the stock in the past 3 months appears overdone, and the crude price volatility impact on the earnings is limited to just about 2%, as 95% of the domestic crude production is capped at $75 earlier. While brokerage also believes that the consolidated EPS should also benefit from improved earnings outlook of HPCL, and it also has added that the recent regulatory actions bode well for the company's improved profitability going ahead. Also, it has indicated that the likely ramp up in KG basin production in Q4 FY25 or Q1 FY26 is a key trigger for the stock going ahead. And the stock is currently trading at 6 times its 1-year forward PE. That's the reason the stock remains in focus today on back of this note.
Thanks so much for that, Upasana, one of the top gainers as far as the Nifty is concerned. Well, Hindustan Zinc and MOIL are in focus on the back of the Q3 business updates. Nigel joins in with the key highlights.
Well, that's right. Hindustan Zinc, actually, the numbers are a little bit subdued, and you have the dollar index as relatively stronger, which normally doesn't bode well. But from the lows of the day, the stock has recovered. Keep in mind, it's been a big underperformer even after that OFS has been done. So just to run you through a few numbers, the mined metal production was down by close to 2%, though the saleable metal production was more or less flattish. How is that possible? Well, zinc was relatively higher, while lead was a little bit lower on a year-on-year basis. The silver production, normally it would have been a disappointment, but the street, it appears they expected that because silver was down by close to around 18% year-on-year. But that's because of a change in sequence, mining sequence at the SK mine. But the street was prepared for that. So that's why we've seen a bit of a U-turn in the stock. It started mildly in the red and now it's at the high point of the day. Liquidity, as always, is quite limited in Hindustan Zinc. Moving to MOIL, the stock has come off a little bit from the top. Remember, it's already corrected more than 35% from the recent peak. Now, they have achieved the best ever Q3 performance in the past quarter. The sales number is up by close to 13%, and the production number has come in at around 4.5 lakh tons. For the 9 months, though, it's not that great. It's up by around 3.5 to around 4%, both on production as well as sales. So that's telling you that the last quarter was much better. Otherwise, things were a little bit subdued in the first half of the year. The management also says that they are poised to deliver their best ever revenues in the third quarter. Explains why the stock is up close to 3.5%. Back to you.
Thank you very much for that. As we slip into a break, up next today marks 15 years since the cryptocurrency Bitcoin was launched. We get you more on the currency's journey ever since on the other side.
Welcome back to Trading Hour. It's a special day for the cryptocurrency Bitcoin, as today marks the 15th year since it was launched, and 2024 was a phenomenal year for Bitcoin, where it crossed record highs of $100,000. Manisha brings us more on how the world of cryptocurrencies evolved in 2024 and what to expect in the new year.
2024 became a landmark year for cryptocurrencies. Bitcoin smashed through $100,000 mark to hit all-time highs at $108,000, surging 130%. The crypto market cap also hit a record highs of $3.9 trillion. The year 2024 started on a very high note with launch of Bitcoin ETFs, which gave an easy access to individuals and institutional investors without the complexities of wallets and private keys, accumulating more than $110 billion of inflows. Ethereum did not lag too far behind, with ETF inflows above $2.7 billion, making its place in decentralized finance. Well, the institutional investors now own 20% of all Bitcoin ETFs traded in US, and then it was Bitcoin halving, an event that happens every 4 years. It leads to reduction in the block rewards by 50%, lowering the supply of Bitcoins. And then it also was about rally taking wings after the US President-elect Donald Trump's pro-crypto stance. He has pledged to make US the crypto capital of the world. He also suggested that the US Bitcoin reserve could be a possibility, and there was also a discussion of using Bitcoin as potential tool to repay the US debt. Trump also has nominated Paul Atkins, who's a known crypto advocate, to succeed Gary Gensler as the US SEC chair, which the crypto bulls have totally cheered, expecting favorable regulations going forward. Well, then you had the Russian President Vladimir Putin also recently saying that no one can prohibit Bitcoin, showing support for cryptocurrencies. The approach from Poland, Italy, and even China showed signs of revisiting previous critical policies. And then, after El Salvador, countries like Tonga, Paraguay, and Panama are now considering adopting Bitcoin as a legal tender. Well, the cryptos also are taking support from wider adoption of real-world assets. Stablecoins are emerging as payment tools for enterprise businesses. The year 2024 also had its share of frauds, hags, and rug pulls. The sector lost nearly $2.3 billion in 2024 in frauds, which clearly is lower than the last year, but nonetheless a big amount. The names that went through these issues were WazirX, Radiant Capital, DMM Bitcoin, among many others. While the Bitcoin grabbed all the spotlight, altcoins also delivered significant returns. Tokens like Solana, Ethereum, Ripple, Cardano have all hit all-time highs in this year. While lesser-known altcoins like Palm AI, Mantra surged anywhere between 10,000 to 20,000%. Well, in the past year, meme coin market capital also was in favor. Market capital hit $113 billion, led by Dogecoin and Shiba Inu as per CoinGecko data. 2025 shows a lot of promise for cryptocurrencies and also blockchain as a technology. The markets have put even higher targets for Bitcoin for 2025, with Standard Chartered and Bernstein expecting $200,000 for Bitcoin. MicroStrategy expects Bitcoin to rise 29% per annum for the next 21 years. But remember, it's a volatile space with significant risks. With so much unknown about projecting its future returns, it's always pays to be cautious.
Interesting and data-rich, update from you, Manisha. Thank you very much for that. Get into a break. On the other side, we'll discuss technicals. Mitesh Thakkar will join in with his top trading bets. Welcome back. The big mover of the day is Avenue Supermarts, trading at a 15% upper circuit following a strong business update for the third quarter. Vinny is here with the numbers. Vinny.
Yes, so we're seeing a good move coming in Avenue Supermart, and the business update does merit it because they saw 17% revenue growth on a year-on-year basis in terms of standalone revenue. 15,565 is what the revenue has come in at. Last quarter, the growth was 14.2%. So the pickup in terms of the pace of revenue growth is what we've seen. Also a pickup in terms of store growth, because this time they've added stores, 10 stores that are added during this quarter. Last quarter, they just managed to add 6 stores. Overall, the total number of stores at the end of December 31st, 2024, it is around 387 stores. Now, we have brokerages also that have come out with a note on this, quite divided in terms of that, because CLSA continues to maintain the outperform rating. Target price of 5,360 rupees per share. What they talk about is the sales growth versus the previous growth. So they said that there's a pickup in terms of momentum of growth as well as the stores that are added during this quarter. So they maintain that outperform rating. But on the other hand, we have Citi, who is maintaining a sell rating, target price of 3,500 rupees per share. The concern that they are highlighting is that maybe there could still be an impact of adverse product mix that could be impacting the company in terms of the margins. The increased competition from quick commerce is a factor that one should be considering when looking at Avenue Supermart. PE multiples are quite high, and that is a concern that they have highlighted on this front. So that is why they are maintaining their sell rating and a target price of 3,500. Goldman Sachs also, they said that yes, there's an improvement in terms of overall sales in Q3 FY25 for the company. That's why the target price as well as a rating is what they're maintaining, but it continues to be a sell rating because they are also cautious in terms of the increased competition quick commerce. And lastly, Morgan Stanley maintains an underweight rating, target price of 3,702 rupees per share. They highlight in terms of the SSSG growth and overall the top line growth of the company is still below the peak growth levels for the company. So that is why they're a bit cautious, but all of them have highlighted an improvement in Q3 in terms of the revenue growth.
Thank you so much, Vinny, for that. DMart or Avenue Supermart up over 13% in the session. Well, a couple of stocks that have now hit the day's highest point, and they've built onto the gains they've been seeing since the start of the week. The first one, of course, is Maruti. Another 1.5% higher for Maruti today. And have a look at Tata Motors, almost 2.5% higher in today's trading session. These are very large moves for the auto pack in this particular week itself. But moving on, another stock that's doing quite well from the BFSI space is Bank of Maharashtra. The stock has rallied quite significantly following its Q3 business update. Abhishek is here with more details.
The Q3 business update of Bank of Maharashtra shows weakness in deposit growth sequentially. That's been seen in the industry level as well. However, the loan growth seems to be pretty impressive and very robust. So take a look at the deposits. That growth is about 13.5% YOY and about 1% sequentially. Even the CASA momentum has been fairly stable on a sequential basis. On absolute value wise, CASA has moved up in line with the overall deposit growth. So that's helped the CASA ratio remain almost stable at about 49.3% in this quarter versus around 49.3% that they had in the previous quarter. However, what catches the eye is the advances growth, and advances growth have been pretty robust at about 21.2% YOY and about 5.1% sequentially. That's helped push the credit deposit ratio up to almost 82% versus 76.8% in the same quarter last year and around close to 78.7% in the previous quarter. So this up move in credit deposit ratio can help the net interest margin either improve or remain on the healthier side if slippages remain under control for them. Back to you.
Thank you very much for that. Let's get to Mitesh now on the show. For the markets, a little bit of a recovery. We were down 170, 180 points, now down 130 points, closer to 24,050. Mitesh is now with us for a quick technical check on the markets. Mitesh?
So I think there's a disclaimer that, we have positions in the market on the long side. My idea was to buy into any kind of decline which the GIFT Nifty in the morning was indicating, and we have bought some call options. As long as we are about 23,950, 920 zone, I think the immediate direction will be on the upside. And hence, we believe that till those levels are broken, I think maintain a slightly long bias. And in fact, today's decline, I think, was a good buying opportunity, or rather is a good buying opportunity in stocks as well. I think what's doing well is possibly, the auto pack, which was also buzzing yesterday really strongly. So I have a buy on Tata Motors with a stop at about 773 and a target of 815, 820 can be looked at on the upside. And the other one is sell on Persistent, which I would want to sell once the stock breaks below 63.10. So then take a short position with a stop at 63.80. Look for a 61.50 kind of a target.
Thanks so much, Mitesh, for joining us, giving us a view on the index as well as your individual trading calls. Well, one stock that was in focus yesterday and that did see quite a bit of a sharp correction was Petronet LNG. There's been a bit of a recovery today, and this on the back of fresh brokerage calls. Hormuz joins in with more details.
Brokerages are just highlighting some key triggers to watch out for Petronet LNG going forward. Remember, it was a big underperformer yesterday at a time when the market moved up almost 400 points. But JP Morgan has maintained its buy recommendation here, 377 rupees price target, a potential upside of almost 15% from yesterday's close. Now, what they say is something that what Petronet LNG said in its clarification yesterday, that PNGRB does not have the authority to regulate the LNG regas terminal tariffs. And in general, if there are tariff regulations, that will not be ideal for Petronet LNG going forward, although they do say that this overhang is likely to persist in the near future for the company. They highlighted some key triggers for the stock going forward. One of them is that the capacity expansion of 5 MTPA that will be completed by March, the seasonal uptake in power demand that is likely to take place, and of course the additional tariff increase of 5% from this month, which is something that PNGRB also highlighted in its paper. Now Morgan Stanley is equal weight on Petronet LNG. It's a 400 rupee price target. What they say is that these concerns on these regulatory actions are overdone on Petronet LNG, and even they highlight some near-term triggers, one of which is this capacity expansion that JP Morgan also spoke of. The others include the normalization in Asian LNG prices post the end of the winter season, the better than expected near-term earnings for the company because India's LNG imports have been a lot higher than expected, so the stock is likely to do well on that front. And what they also say is that the Dahej terminal, which is in question right now for Petronet LNG, it remains the most well-connected terminal to India's natural gas grid, and as a result of which they say that the valuations currently look attractive as more clarity emerges on the volume growth for the company in FY26 and in FY27. So overall, both of them have highlighted some key triggers with an average upside potential of anywhere between 15 to 18%.
Thank you very much for that. That's the word coming in from Petronet LNG, up 1.4%. But PFC and REC are also in focus because Emkay has initiated coverage on both the stocks. Abhishek is here with the details.
The power finances are up in trade today as we have one of the brokerages, that is Emkay, initiating coverage on both PFC and REC. They have given buy recommendation for both the stock. Target price for PFC is around 600 per share and REC is about 650 per share. They say that their optimistic stance is underpinned by three factors. So, number one, plant capex for FY23 to 32 is about 33 lakh crore, which gives long and high visibility on growth front for these lenders. Now, previous cycle lessons have been learned. There is continued benign competition from banks and gradual diversification approach taken by these lenders, which augurs well. So, they provide reasonable comfort on NPAs and hence added confidence with respect to the profitability of these lenders. Now, valuations are being on the higher side than the long-term average, but they remain palatable given the fact that growth and profitability profile is very strong. So, AUM CAGR that they have estimated is around 13 to 18% for PFC REC over FY24 to 27. And they also expect the entities to clock in an ROE of around 19% to 20% over FY25 to 27. Back to you.
Thanks so much for that, Abhishek. Both the power financial stocks doing quite well in the session today. Let's now take a short break. Up next, we'll discuss the way forward for the market with Ashi Anand of IME Capital. Welcome back to Trading Hour. Well, there's been a very sharp recovery in the market, especially in the last 20 to 25 minutes. The Nifty has recovered quite sharply from the lows it made at around 11 a.m. Now just down around 40 points. But as promised, we have Ashi Anand, CEO and founder of IME Capital, joining us now to discuss his views on the market. Thank you so much for joining us, Ashi. First up, wishing you and the team a very happy 2025. How are you looking at markets in the current space, and especially given the fact that you have digital-first portfolio, if you could call it that, how are you looking at that side of things?
So firstly, thank you so much for having me on today's show. Wishing all the viewers a very happy new year. Just kind of starting off with the market outlook. What we do expect markets to possibly remain a bit subdued over the next 3 to 6 months. What you have seen over the past, the second half of last year, is you're seeing a clear slowdown in growth. Economic growth has come down. You're seeing corporate earnings having weakened. And importantly, a couple of weeks ago, the Fed also changed their outlook in terms of interest rate cuts over the coming year to 50 basis points as compared to 100 basis points. So at this point in time, you're really seeing a market which is missing any important triggers for growth, and which is why we can expect it to possibly remain a bit subdued until you're starting to see growth starting to come back. And I think third quarter results will be very, very closely watched. So that's a broad kind of overall outlook on the markets. We believe that you are going to need greater signs of growth recovery or interest rates being cut in order to get the positive sentiment that we've had over the last couple of years, that kind of a market environment for that to come back. In terms of our digital portfolio, now this is a theme that we continue to be extremely optimistic about. It's a strategy we launched in Feb of last year. The strategy has done extremely well. It's up over 100% in less than a year and a half. Now, the core thesis on the digital strategy is that you are seeing a tremendous amount of value migration taking place from traditional businesses towards new age digital platforms. This value migration, we believe, is still in very early stages of adoption. There are multiple different fundamental drivers that are going to actually lead to accelerated digital adoption across the Indian populace. And this is something where we believe growth in these platforms can continue to be at a very high pace over the coming decade. And this accompanied by a shift towards profitability. And if you understand the business models, these companies tend to spend a lot at early stages, but can really focus on monetization quite significantly as they enter a monetization phase. A combination of very strong growth and a shift to profitability, we believe, can lead to very attractive value creation. And it continues to be, I think, the one space in the markets that we continue to be the most bullish about.
So, Ashi, when you have to deploy incremental money in all the stocks that you own in this portfolio, which includes from a Nykaa to a Swiggy to Nazara to PB Fintech, Delivery, all the stocks are, a part of this. Some have fallen more than the others, some continue to rise. So, incremental money deployment will happen in which company? Where is it that in your portfolio there is most value in terms of stocks?
Sure. So we're not getting to a very specific, stock specific, right? We continue to be very comfortable on most of the holdings. And some of our larger holdings, the Zomato, the Policy Bazaars, these companies have run up quite considerably. But we are seeing a very clear longer term growth runway. And if you just take US tech as an example, between 2010 to 2020, most US tech companies were just in a structural bull market. And even if you bought 2 or 3 years later, you still had large upsides to play. We see something very similar in a number of our companies. Zomato is up 5x from our original purchase price. But if you're looking at a company that has a traditional foods business that can grow, that we believe can compound revenues at well over 15-20% over the coming decade, you have Blinkit, which is at very early stages of evolution, which could arguably compound revenues at 35, 40, 50% over the coming decade. These are very large growth numbers of very high bases. If you look at how these companies are going to transform in terms of profitability, you have already seen these companies come out of deep losses and moving towards adjusted EBITDA break-evens. But as you go into FY 27, 28, we believe the overall profitability levels of cash flow generation are all going to surprise the markets significantly on the positive. This combination of growth and profitability leads to still what we believe to be very attractive stocks, even at the current price. So incremental money that we are getting, we continue to kind of deploy in existing holdings. Some of the stocks that have moved up quite significantly continue to be amongst the top weights because these are also the highest quality franchises that we are seeing out there.
Understood that, Ashish. So incremental money too, you are comfortable deploying in the same holdings. Well, a couple of interesting holdings. You own both Zomato as well as Swiggy. You also own Zomato indirectly, through your holding is InfoEdge as well. So give us a sense of, how are you looking at the recruitment vertical of InfoEdge? There's also 99 acres. So what is your view on those particular industries? Do you feel that the digital disruption will come in there as well?
So, when we're looking at the portfolio, we really do bucket our holdings in terms of, there are differences clearly in terms of, one, both the growth potential, as well as the competitive barriers to entry and the ability of different companies to enter new adjacencies to kind of create value. And if you're looking at our portfolio holdings, that would really reflect in terms of the much larger weights we hold in certain platforms that we believe really fit these three buckets very, very well. InfoEdge is probably a slightly lower weight. It's about 7 to 8% of the portfolio. That comes about from the kind of belief that on the core kind of Naukri portal, while you are being able to continue to grow and you are kind of growing in the mid-teens, IT growing a bit slower, non-IT growing faster, this is not the same level of growth that you are seeing in some of the newer age digital platforms. That's happened because, one, you clearly have seen much greater online penetration of job searches in India. It's also a kind of a field which started, I think, a good 5-10 years before the Zomatos and the Naukris, the Zomatos and the Swiggies came about. So this is a segment which is a lot more penetrated, and therefore we aren't as optimistic on growth here as, say, for example, in some of the other areas. If you're looking at something like 99 acres, this vertical has held a tremendous amount of promise over the past decade and a half. But I think what is a concern is that they don't seem to really have a clear ability to monetize what is clear market leadership. The classifieds business, where is more just an advertising platform as compared to a Zomato Policy Bazaar, where you're actually facilitating transactions. The level of value creation on these platforms is not as high as when you're facilitating transactions. Which is kind of where InfoEdge is definitely an interesting company. They've got clear leadership in some interesting kind of verticals. However, jobs, we're not so sure on growth. On 99 acres, we're not so sure on the path to profitability. The one part we find quite interesting is the whole usage of cash flows to create a VC fund to fund new startups. That is something where a lot of value could be created. And that kind of reflects in terms of the way you see different portfolio weights of this portfolio.
Any new ideas that you are exploring in both your portfolios?
So there is so Swiggy is a recent introduction. We are kind of quite closely monitoring how Swiggy narrows the gap, both in terms of growth and profitability to a Zomato. Depending on how that plays around, relative weights between Zomato and Swiggy could change. That's the most recent introduction, which is in the digital portfolio. It clearly is something which has a tremendous amount of longer term value, and we really look at it as Zomato and Swiggy being a play on what we believe to be one of the most attractive themes in digital. So that's what we've got in terms of new introductions on the digital portfolio. There are a couple of SaaS companies that we are evaluating, but we've not yet made our mind up in terms of do we really include them or not. They may come in as possibly certain smaller weights. In terms of other more diversified portfolio, I think the space that we are watching quite closely, we believe within banking, certain segments have gotten quite badly hit because of the current problems that you're seeing in microfinance, as well as in other parts of unsecured lending. With a number of these stocks having corrected quite significantly, we are seeing quite attractive value there. We're not sure if these stocks have yet bottomed out, possibly still a quarter and a half. But that is the kind of space that we are evaluating quite closely.
Understood that. Thank you so much, Ashi, for joining us and giving us your view both on how exactly you expect the digital side of your portfolio to perform. Well, moving on, CNBC-TV18 has reviewed orders passed by a US court assigning cases filed by the SEC and the New York criminal cases against the Adani Group to a single judge. Parikshit is here to tell us more.
Well, we have been following this case closely, and we know that there are two cases that have been filed in the United States against Gautam Adani and others for alleged bribery of Indian government officials, state government officials, in connection with a effort to secure solar power contracts. And they have been charged for misrepresentation and bribery in the United States because in a way they have misled US investors. Now, what has happened is that a US court has assigned now all the cases in this matter to a single judge. The cases have not been combined, but now will all be heard by a single judge for judicial efficiency. The court has also noted that all the cases arise from similar allegations and from the same transaction of events. So they have been assigned to one US district judge who will be hearing the matter, and he will be looking at both the SEC case, which leads to market developments and market violations, and the criminal case which had been filed at the Eastern District of New York Court, now which was a criminal case against Gautam Adani and others, where their imprisonment and warrants were also issued. So let's see what happens in this case. Adani Green Energy is at the center of these allegations for paying $265 million in bribes to Indian officials. Now, this is as per the US DOJ. The Adani Group has refuted all these allegations, saying that the Adani Group or Gautam Adani and his associates have not been charged for corruption or under the US Foreign Corrupt Practices Act, but they have been accused of securities and wire fraud and misrepresentation by the US court. So what happens now is that all the cases are moving to a single judge, and this could speed up the manner in which these cases are taken up in the months to come.
Thank you very much for that, Parikshit. Get into a break. On the other side, we'll be joined by Pawan Goyal, ED and Chief Business Officer at Naukri.com, to talk about the December Naukri JobSpeak data. Welcome back. As we enter into 2025, Surbhi is now joining in with the 5 key factors that the markets will be watching out and looking out for this year.
From geopolitics to global trade to the economy and interest rates, there's a fair amount of uncertainty and plenty of moving parts as the stock market welcomes the new year. So let's boil it down to the 5 major factors that will drive markets in 2025. Number 1, the US economy. Will America be great again in 2025? American exceptionalism became a catchphrase by the end of 2024 as Donald Trump swept the US election. It was all about the great return home trade again. Contrary to fears of recession, the US economy roared solid in the year with the third quarter GDP at 3.1%. The main issue before markets now is the shape and form that Donald Trump's economic policies will take on 3 key aspects: tariff increases, extension of the 2017 corporate tax cuts, and any changes in immigration policy. On tariffs, the world is holding its breath. Some, like UBS, feel that the impact of the 60% tariffs on China will be felt only by 2026. That is, if these kind of tariff increases are announced to begin with. Wall Street is elated with the likely extension of corporate tax cuts. But Bond Street is already showing its displeasure with the rise in US yields. Which brings me to the second big factor to watch in 2025. The US Federal Reserve rattled markets in mid-December by announcing that it will probably deliver just 2 rate cuts in 2025 instead of the previously projected 4. The reason? Solid economic growth and sticky inflation. US GDP growth expectations range anywhere between 2.1% to 2.5% for 2025, even as inflation remains sticky. The Personal Consumption Index, which is an inflation measure that the Fed closely monitors, grew 2.1% in September, 2.3% in October, and 2.4% in November, well above the US Central Bank's 2% target. Now, what is also forcing the Fed's hand is the expected inflationary nature of Trump's fiscal policies and the massive debt that the US government is already running at close to $36 trillion at last count. Now let's move to the next piece of the puzzle, China. The dragon is gearing up for a potential tariff fight with Uncle Sam. China is expected to run a budget deficit of 4% of GDP next year, which will be the highest on record. The number was 3% in 2024. PBOC is expected to cut rates in the coming months, and it may also allow the yuan to weaken to boost Chinese exports. All this while the country most likely retains a GDP growth target of 5% for 2025. The official estimates and policy action will be announced only by March after the country's parliamentary meeting. Markets will wait to see if the fiscal and monetary stimulus will indeed be the real deal this time. The announcements are likely to keep markets volatile, with traders hunting for lucrative short-term trading opportunities. Coming to factor number 4, India, our macroeconomic story and slowdown fears. The 5.4% second quarter GDP print has led to a big clamor for bigger policy response. The street is expecting the new boss at RBI, Governor Sanjay Malhotra, to usher in a rate cut cycle starting early 2025. The problem, however, is inflation. While November CPI inflation cooled off to 5.48% from a red-hot figure of 6.2% in October, the RBI does expect inflation to remain sticky. It raised the full year FY25 CPI inflation projection to 4.8% from 4.5% in the December policy itself, while cutting the GDP growth forecast to 6.6% from 7.2% earlier. The RBI will also have to keep a tight watch on the rupee, which has depreciated past 85 to the dollar in the middle of December. What could offer some comfort to growth is the widespread belief that government spending will pick up in the second half of this fiscal year, having contracted nearly 16% in the first half. The government has spent just about 37% of its budgeted capital expenditure, so the second half optimism is perhaps well placed for now. Finally, we come to factor number 5, earnings and fund flows, the fuel of any bull market. Corporate earnings growth moderated sharply in the first half, with the Nifty earnings rising just 4% in the second quarter, which is the lowest in the last 17 quarters. Most brokerages expect single-digit Nifty earnings growth in FY25. Motilal Oswal, for instance, expects just 5% growth. Hopes are pinned on a pickup in government capex as well as a rural recovery in the second half. The street is, however, divided on the outlook for the coming year.
Morgan Stanley expects 18 to 20% earnings growth over the next 4 to 5 years, led by an increase in private sector capex and a structural rise in discretionary consumption. The firm expects the Sensex to rise 14% in the new calendar year 2025. Jefferies, meanwhile, is more measured in its optimism. While it expects the rise in the government's populist spending to support consumption, it sees the massive IPO rush and block trades as an overhang. Jefferies warns that large equity supply has been exhausting domestic liquidity and retail flows may actually slow down in 2025. The brokerage has a December 25 Nifty target of 26,600. Now, this heavy equity supply is a concern for Macquarie as well. The firm does not rule out the possibility of a 10% correction in the market in the first half of 2025. Now, 2024 has been a watershed year for the Indian market when it comes to retail participation. Mutual fund investors pumped in over 3.5 lakh crore rupees in equity funds this year, offsetting the heavy FPI selling that we saw in October and in November. While most on the street believe in the Indian market's long-term potential, it is this faith and resilience of the ordinary Indian investor which will probably get tested in the coming year, one that is likely to be more volatile and confusing than the near straight-line returns that we've seen since COVID.
Well, very, very interesting there from Surbhi. But staying with the market, remember earlier today we spoke with Mark Mobius, the chairman at Mobius Emerging Opportunities Fund, and he says he remains optimistic on the Indian market and is looking at companies that have a semiconductor orientation. Let's listen in.
I think going forward, you're going to see a very good market in India. And India, I believe, is going to benefit from the Trump administration. Simply because, first of all, the Trump administration will not favor the Chinese market. And if you look at the global picture, where else can investors go overseas? Where are the best places? And India comes up all the time because of the incredible growth of the country, because of the reforms that are taking place under the current government, and simply because there's so much value in the market. Companies with very high return on capital, etc. So I'm continuing to be optimistic about India generally. Well, first of all, I would look at export-oriented companies to begin with because of the currency situation, and also simply because India is gradually becoming more and more competitive against the Chinese export. But those companies that are exporting, let's say Infosys that exports a lot of software, they are going to become more competitive because of the weakening rupee. So I think you've got to look at many of these stocks that have a US dollar income component will continue to do very, very good. Trump is going to lower taxes. Secondly, he's going to cut out a lot of the bureaucracy and a lot of the paperwork, a lot of the impediments to doing business in America. This is going to be very, very good, not only for American industry, but for foreign industries. Because you must remember, if you cut out a lot of this bureaucracy, it'll be easier for Indian companies to do business in America. But I believe that going forward, what I want to look at is companies that have an orientation towards the semiconductor industry. Unfortunately, we have not yet been able to isolate such companies, but we're going to look at those very carefully because I believe India is going to become a big competitor in not only low-end IT and low-end computer chips, but high-end as well. So I believe that's one sector that I want to look at more carefully.
As we slip into a break, here is some good news for all our viewers because India's business news leader is now just a click away. We're introducing the all-new CNBC TV18 app, so get instant access to breaking news, in-depth articles and financial world updates at your fingertips. Download the CNBC TV18 app now from the Apple Store or the Google Play Store. Welcome back. Now, according to Naukri JobSpeak Index, we saw a robust 9% year-on-year and month-on-month growth in the IT sector. Remember, this was a sector down. AI-related jobs have seen a robust jump of 36%. GCCs continue to hire. FMCG was the bright spot this time, though some sectors like BFSI retail continue to see a decline. So to talk more about the trends, the way forward, Pawan Goyal, the Executive Director and the Chief Business Officer at Naukri.com, is with us on the show. Pawan, thank you very much for joining in. This is Rima here. So first, give us the key trends and the numbers from your Naukri report, JobSpeak Index.
Okay, so as you mentioned, Naukri JobSpeak is up 9% in December. Now, I think the interesting thing, if you look at, since December is also the year, calendar year end, you can look at the year as a whole. So what you saw in Q1, the JobSpeak was -10, and getting into calendar year Q4, JobSpeak went to +7. So every quarter, JobSpeak has improved from -10 to -5 to +5 to +7 for Q4. So it's a story of recovering white-collar jobs and in this calendar year. Now, if you take from an IT perspective, IT is flat overall from the year-on-year comparison perspective, but as you clearly called out, GCCs are growing at a 15%. The other story that stands out for this year is while Indian job market was a lot more dependent on IT, this year there's been more secular growth across industries. So the non-IT sectors such as FMCG, oil and natural gas, travel and tourism and hospitality, FMCG, these have all done well and have contributed to the overall growth in white collar.
Pawan, one particular trend that stands out is actually the FMCG hiring growth. You just mentioned it, other sectors apart from IT have pitched in this time around. 18% growth in this particular index as far as FMCG is concerned. What led to this particular kind of strong growth, and is this sustainable or is this a one-off?
So we've seen FMCG being the top sector even in Q3. So it doesn't look as a one-off. Now, whether it will sustain, it's gazing into the crystal ball, which I'm not well positioned to do. But it's not a one-off is all I can say. Now, one of the things, if you delve deeper, consumer durables have done well within FMCG sector as well. Okay, the consumers and what we've also seen is this some of this growth is there in not just in metro but non-metro cities as well.
Retail has been subdued. Is it just a post-festive demand sluggishness seen in the month of December, or retail has been weak for some time now? And just to continue that point about FMCG, your report also talks about fresher hiring picking up to 18% in FMCG. And that's the highest growth rate that we've seen at least for some time now. So explain that to us. What could be the potential drivers for that?
Fresher hiring, as you know, was subdued throughout the year. Okay, this is the first time fresher hiring has picked up, and that too it's driven by FMCG, wellness, lifestyle, creative industries such as architecture. Those are the places where it has grown. I believe that usually fresher hiring is driven when the your pyramid is not well balanced, as in you started becoming top heavy. And so my suspicion is in FMCG, they did not hire fresher for a while, and this is positioned for future growth, and that's when you usually hire freshers. So that's what is happening in FMCG. Now, throughout the year, what we saw, not just in FMCG, across every other sector, was experienced hiring was the focus. But now fresher hiring opening up, not just for FMCG, but other sectors also is an indicator usually of future growth.
Pawan, one particular sector, while there has been growth throughout, one particular sector that stands out in terms of a degrowth of quite weak hiring trends is actually the BFSI pack. Both banking as well as insurance has seen hiring go down. What is the reason for this, or do you think this is seasonal in nature and by Q4 we can see a rebound there?
No, so seasonality is captured because it's there. If we are doing year-on-year comparison, so seasonality is captured. So the reason is very hard for me to give you, but it's not a seasonality driven is what I can really tell you.
But is it because of increased regulations, regulatory action on the NBFC side that BFSI has been a bit weak? And for how long? Can you give us some historical trend to how BFSI has performed in terms of hiring? Because I remember some conversations with companies like TeamLease, Quest, and they also spoke about softness in BFSI hiring.
Yeah. So how long it will last is hard to predict, Rima. What I can say is BFSI, if you go back a couple of quarters, was doing very well. It was actually one of the sectors which was growing very fast. Okay. So what has changed from a BFSI point of view? I think you're right to allude to regulatory landscape, but is that what has driven it? It's hard for me to comment. And from a Naukri platform, what we can see is the actions. We don't have the reasons behind those actions. And I, as a job platform provider, I don't want to speculate on the reasons of why it might have happened.
Pawan, one last question. Could you give us a trend or a sense of how exactly Q3 billings have panned out as far as the platform is concerned?
Sorry, we are in the quiet period. I can't talk about that. But there is some other interesting trend that we did not touch upon that I think you may want to know. If you were to take a guess on which state was growing the most, you'd normally guess state with one of the metros. But you may be surprised to know Odisha is the state which has grown the highest year on year. Okay, overall from a calendar year perspective. So Odisha, Madhya Pradesh, Rajasthan. These are the top 3 states in terms of year-on-year growth. Okay, and I find that interesting because it's not something that I would have normally imagined. Okay.
Interesting. Thank you very much, Pawan, for joining in. We look forward to these conversations which give us a color on the economy and the hiring trends on the ground. Thank you and wish you, your team, your family a very happy new year. And that conversation brings us to a close on Trading Hour. From the entire team, thank you for watching. Don't go anywhere. Halftime Report is up next.